We are seeing geopolitics and local factors playing to advantage of India. Budget is going to give flip to consumption and lowering of interest rates, and also eventually driving private sector investments. And on the geopolitics side, with India's less net exports to GDP being less than 2% of GDP, which is the lowest in all emerging markets, India is least exposed to the geopolitical risk out of Trump's second presidency and any tariff war. In fact, it could play to advantage of India, just the way the first Trump presidency gave some new sectors to India, like electronic manufacturing services, renewable equipment, drive more growth in auto ancillary exports as China Plus One emerged as a theme. And you know, the big mobile manufacturers, the biggest, wants to increase their India production to 1/4 of their global production, and they're already more than 15%. There are reasons to believe that actually it could be positive rather than negative.
Right, so you see reason to trade the opportunities with the trade war regarding the US and China, that India could actually emerge once again as a beneficiary of that, and there are sectors which could look quite good if you wanted to play that theme.
True. Indian market with more than $4 trillion market cap and very wide diversification has actually become very good source for stock picking for active investors. You have a significant part of India which is linked to US macro, more in context of US GDP. More than 10% of Indian market cap is from IT services stocks. And these are more linked to how the fortune is of Morgan Stanley, Goldman Sachs, all the US big banks. And if US economy does well, these will gain.
Right.
So you, being a GARP investor, we are seeing opportunities across board, both the domestic and export-oriented sectors.
But what about those that say it's expensive?
Because the market is big, and at any point of time, there will be, I'll just give you some numbers, with more than $4 trillion market cap and every sector, large sector, being more than $400 billion of market cap, there will always be sectors which are out of flavor just for short-term negative reasons. It could be a temporary earning slippage, and these valuations will become cheap, or there could be corporate actions, or some corporates who are getting technology, innovation right, gaining market share. So you do get growth at reasonable price opportunities because there's so many sectors to play and the liquidity is so large.